Hi all, I wanted to explain why I think for me the broken wing butterfly is the best day trading strategy out there. So first of all, I will explain why I like trading options. Mainly it is because it options give me the most control over my risk reward profile. And that's the basic reason why I like to trade options over stocks, futures, anything else. And so that's what I explain to people. It gives me the most control. And why do I like the broken wing butterfly for day trading the most? Well, the reason is because I feel the broken wing butterfly takes all of the frustrating aspects of trading options and turns them on their head. And I'll explain why. So if you are just buying an option, which is a perfectly viable way to trade options. You just buy an option, buy a call, and if the stock goes up enough, you make all this profit. Um, the frustrating thing with that is that options have theta decay. So options are always decreasing in value based on the passage of time because they expire. So in order to turn that frustration around, um, I like to sell options. I like to create positions where I have theta decay working in my favor. And while doing that, I prefer to have defined risk. So that involves also buying other options to create defined risk so you're not taking unlimited risk, which is not recommended unless you know what you're doing and you have the notional um, risk aligned with your capital. So for day trading, defined risk um, positions where you have theta decay working in your favor is my preferred method of trading. Now, one very common and popular way of selling premium, as you will, or putting theta decay in your favor is to take a neutral strategy like an iron condor. Or an iron fly is another way. So if you have um, both of your short options at the same strike, then you have a fly, but an iron condor um, is considered a more high probability trade. And I know there are people that successfully trade iron condors, maybe not as much on day trading with 0 days till expiration. There's a few out there. Um, the reason that iron condors are not my thing anymore, I traded neutral strategies for uh, almost 20 years, actually. And if you are going to create a high probability neutral trade, you usually end up with a way higher max loss potential than your profit potential, especially if you follow the strategy that a lot of people do and a lot of studies recommend where you take profit early. So if you reach like 50% of your profit potential, you take it off because then you have the high probability of the trade actually being profitable. You give it way less time for it to go off into your loss area. Um, so there's that, and the other thing that's frustrating to me for delta neutral strategies like this is that you're hoping for the price to stay put. You're hoping for it not to move too far. And that's a frustration because, I mean, I've had kids, and if you have, you may understand this. One of the most frustrating things in life is to hope for something to stay put that really wants to move and go somewhere. So you're just constantly watching and hoping that this thing is not going to keep moving this way or the price isn't going to keep moving up. So those are the two drawbacks. You usually end up with a trade where you're going to have possibly 4 winners based on your rules, and then the price moves too far, and then you end up with 1 loser that wipes out your last 4 winners. Happens. That's just a normal part of trading this kind of trade, and while some people are very successful with it, it's not for me. So the second best strategy, I think, is credit spreads. And part of the reason for that is depending on how close you're going to get to the at the money, you can get your risk reward ratio to be a little better. Maybe usually at best it'd be 1-to-1. If you're trying to create a more high probability trade, it will be worse. I mean, the probability is always kind of way out, but what I like about credit spreads is that you end up with this full profit area. So as long as the stock moves in one direction that you prefer, it doesn't matter how far it goes, you're still going to be profitable. You've got a lot of space where it can go. Of course, it's sometimes going to go against you at maybe 50-50. Maybe a little bit more in your favor because you can move these out, but you have a lot of profit area. So you have a lot of situations where the price just starts moving and you really don't, you're okay with it if it continues to keep going. You're not hoping it's going to stay within a certain area, which provides a lot of trades that just keep you pretty relaxed and happy. Why I like the broken wing butterfly better than this is because not only do you get this sort of situation, and I'll just quickly explain broken wing butterfly. So it's like a fly, it's like a butterfly where you have your 2 sold options in the middle and you have a purchased option on either side, except you move one side out. So the side that you want to allow for risk and have the other side be your potential profit area. So your risk side, you move further away. So you have a lopsided butterfly, and they call it broken wing because these are the wings, and it looks like one of them is broken because it's closer. This creates my favorite profit profile and my favorite risk profile. If I am bearish, now I can get into whether or not there's any edge in having intuition about price action and where I like to look for breaks of structure and then a retest. People can argue about whether or not there's any edge in entering a trade when that happens. I personally like to believe there is somewhat of an edge there. But either way, even if there isn't, you've got all this space where you could potentially make profit. I call this the runoff profit area because if it runs off in this direction, no matter how far it goes, you're still going to make this certain amount of profit. And on a 0 DTE, usually this is a lot smaller. So I'm showing like a 1-day expiration because today the market's not open. But usually on a SPX 0 DTE trade, I will end up where this runoff profit is around $150, and the max loss is usually around like 350. That's generally what we end up with. So it ends up being similar to a credit spread, except you are a little closer to the at the money with your risk here. So you do give up a little bit of that. But what you gain is this high potential profit if the price ends up back around here toward the end of the day when it's going to expire. And to me, that is worth it. So most of the trades that I enter, I'm like, if I'm entering a bearish trade, the price will head this way, and it'll often just end up over here. But sometimes the price will meander back to where it was. And actually, I'm often surprised it tends to do that on SPX during the day a lot, where it goes one direction. You kind of have confirmation that it's going to be staying sort of in that direction, and then it ends up toward the end of the day just kind of dribbling back to where it started. It just kind of seems to like to go back to where it started. If that's just nonsense to a trader who thinks that everything is completely random, great. But for me, I've been trading many years, and this has become my sweet spot. So the trade can often go off this direction, trickle back toward the end of the day, and then when I'm in the last hour of the day, as it starts to come back into here, I'm just looking for it to get to this spot. And if it starts to kind of creep onto the other side of the spot, I get out. If it's not the last hour of the day and the price has been moving around here, then I have a rule where if it gets into the loss area, I'm just going to take the trade off if the current loss is showing to be more than what the runoff profit is. So if this is $150, then as soon as the trade is showing that it's at negative $150, I take it off. That's my risk management plan. I don't like to wait and just let the trade run its course. That might end up still working, but in the long run, but again, psychologically, I don't think it's easy to just take a $350 to $400 loss when most of your winners are around 150, and you just end up losing that much ground in one trade. I mean, that's basically where the psychology comes in. Don't like to lose more in one trade than I made in one or two winners. So the Optionsmith visualizer does show the current risk profile, which shows you where your loss would be if you took the trade-off right now, or where your profit would be if the price were here right now. And so I've noticed with broken wing butterflies earlier in the day when you first put them on, this going into loss is more gradual than I might have thought. So I actually do tend to get a lot more leeway, where like right here, I had entered a bearish trade, and it came up, and it really didn't run into my manual stop loss amount until it got way up here. So you get a decent amount of room before I have to take it off. So yeah, so that's my trading plan. That's why I like broken wing butterflies for day trading. It is the strategy that I can honestly say fits my psychology best, works best for me. Might not work great for other people, but I think that is the most important thing with trading, is to find the strategy that works best for you, and find the one that fits your personality best. And it's difficult because you might think you found one, and then you trade with it for a month, and then you realize that it just doesn't seem to fit your sensibilities. So again, this is all just sharing my personal experience. This is not advice to enter into a trade. This is I'm sure many people would argue against how I'm trading, but after trading options for over 20 years, I can honestly say that this is where I landed as far as what is consistent for me and what works for my own psychology. So that's it. Enjoy.